You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the Options Insider Radio Network. 13 programs on the old network, including well over 100 archived episodes of Volatility Views. That's a lot of volatility goodness, a lot of great guests, a lot of great conversations in that archive. I encourage you to check it out if you're new to the program or you haven't been delving into the back catalog recently. There's, of course, some timely elements, but, of course, there's also a lot of great, really evergreen stuff that stands the test of time. Because at the end of the day, volatility is volatility today, tomorrow, yesterday, 2 years from now, 10 years from now. Implied vol is still implied vol. So we like to those conversations have a lot of resonance through the years. Which is why Vol Views, I think, does so well for us, even in the back catalog. And where can you find that back catalog? Well, of course, a lot of different places, including the mothership, the flagship, theoptionsinsider.com. Surf on over there. Check out all the great news and articles and education and analysis and unusual activity there, of course, while you're there. And then click on the Insider Radio Network tab, and you can, of course, go off to the races, choose any of the 13 programs, including, of course, Volatility Views, and pretty much you're good to go. And, of course, you can also find us in all the usual places, iTunes, Stitcher, TuneIn, etc. And if that's all too much effort, too much work, then just grab our mobile app, available for iOS, Android, and the Fire OS. No shortage of ways for you guys to listen to our shows, download or stream them. Then if you have questions, you have comments, let us know. Fire them off. We love to hear from you guys. And joining me on the old program today, the major domo of all things derivatives over there at BGC Partners, Mr. Jared Woodard. Jared, welcome back to the old program. Happy Friday to you.
Yeah. Great to be with you. Yeah, I like your intro. They're getting kind of reflective. Implied volatility, the same today, tomorrow, and always.
That's true. At the end of the day, implied vol is implied vol. The number may change, but the core concept remains the same throughout time. Unless, of course, they change the VIX calculation again, then it becomes a whole different conversation. I'm just kidding. Of course, and we are also joined, listeners, by the greasy meatball himself, Mr. Mark Sebastian, the founder of OptionPit.com. Mr. Greasy Meatball, welcome back to the Volatility Views program, and happy Friday to you, sir.
Happy Friday to you, Uncle Mark.
I think you're on the wrong show, but I'll let it slide. I'll let it slide for now, sir,
right,
as we dive right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. If you're new to the program, this is, of course, the portion of the show where we break down the week that was from a volatility trading and analysis perspective. And it started off kind of like a lot of us, I think, were expecting, certainly on last program, that not a heck of a lot really lighting a fire from a broad volatility perspective. Most of the implied vol, most of the indices kind of languishing, not really doing a heck of a lot. And then towards the middle of the week, we had what you can conservatively call a bit of a sell-off, and that, of course, sparked some vol across the board. So the VIX Cash starting off pretty weak towards the beginning of the week, hovering around the high 12 range, and then towards the latter half of the week when things started rocking and rolling, it kicked up nicely, got up to about a little over 17 at one point. We're hovering right now, as we are recording this, listeners, middle of the session here on Friday, March 27th. It is right around 15.5 or so kind of bisecting that range a little bit. We'll see where we go as the show progresses, but a lot for us to really sink our teeth into this week. Perhaps we'll start with you, Mr. Meatball. A lot of stuff cooking from a vol perspective this week. What caught your eye in particular?
I think the really interesting thing was how well the VIX futures were priced the entire time, as VIX dropped to below 13 and then all the way back up to into the 16s. The VIX futures did an excellent job of not overreacting to the VIX getting torched and not really over rallying as the VIX kind of exploded. One of the reasons why maybe the VIX did not have a big, huge pop on Wednesday was because the futures were already priced so well that, it just kind of normalized itself. And so that was really what I think kind of caught me. The other piece is where we really saw volatility was in currency and in still in energy, obviously, and a little bit in the bonds. So just really crazy. We saw bond yields get below 190 at one point this week, which was kind of nuts. And they've since backed off, but just generally a crazy email.
Crazy email for a crazy week. And Mr. Woodard, a lot to parse this week. What caught your eye from a volatility perspective, sir?
One of the things that I noticed this week and last week as well was how the market in VIX options didn't respond quite as quickly or to the magnitude that we would expect on these days when equity markets were selling off. VVIX and index, a lot of folks are really warming up to these days. That VIX style measure of implied vol in VIX options has fallen pretty significantly. I mean, we saw really high levels over the last 6 months when markets really were moving, but lately it's calmed down a lot. I mean, right now the index is in the mid 80s, which is kind of what we would call maybe fair value most of the time for VIX options. Looking back the last few years, but I mean, even in the 70s or even low 80s, these are levels that we had not seen really since October of last year, as so many investors have been pricing in more risk into VIX options. So those low levels have been pretty notable, I think, and given all the moves we have this week, I think it's been maybe surprising that the cost of owning those options has actually been fairly favorable. If you bought some far out of the money VIX calls, say in May, this time last week, I was just pricing these up now, you've basically got a free week out of the deal. They're priced effectively the same place they were 5 sessions ago. So that just kind of tells you the fact that when you've got VIX options priced this low, the market can move, and you're not actually going to take too much of a hit if you, like you are today, where the market's basically unchanged. If the options were priced more expensively, it could be kind of a painful session, but instead, in fact, we're seeing that these low premium levels make it pretty affordable.
Yeah, VVIX has been an interesting beast to watch, hovering right around the 87 level or so as we are recording this show. Of course, earlier in the week, it was dipping into the 70s for a while there, so it seemed like it was coming off. The volatility of VIX was perhaps retreating a bit, and then as the week progressed, it got a little bit more life. I want to go back to a second. Mark, you were talking about VIX futures earlier and performing well. If you guys remember on last episode, we were talking about the process of settlement out there in VIX land and how obtuse and confusing the expiration/settlement process really still is for a lot of people. Before the show started, I got an interesting call from a reporter from a pretty large publication. I won't say which one, but they were talking. They wanted to know, they had apparently heard about some, there's a lot of behind-the-scenes wheelings and dealings, particularly when it comes to the regulators and arbitration and settlements and things. And apparently he had heard of a FINRA arbitration, one of these closed-door deals, where there was someone out there who apparently not only was confused about the settlement process, but actually was when expiration actually occurred. Because apparently this was someone who, again, this is all secondhand, so I don't know any of this firsthand. This is all what the person related to me, the reporter. But essentially they were saying there was someone out there, a sophisticated VIX futures trader to the tune of having assets north of 100 million. I'm not sure if all of that was in VIX futures or what portion was, but it's a relatively sizable and sophisticated VIX futures player who apparently took a bath recently because the broker he was using had the wrong expiration date posted on their platform for the VIX Futures product. And apparently they had it up there for several months. And apparently, according to this source anyway, that FINRA ruled in his favor and that he actually won an award to the tune of $2 million. I don't know how substantial his losses were, what ended up happening. I don't know how the thing unfolded, if he maybe took off the position a day early and missed out on some profits in the market, or he held it and thought he would be out of it, but he wasn't, and the market moved against him. I don't know what the underlying mechanics were, but it just sounds odd on the surface that someone of that level of sophistication and size would not be able to do their own research into what the actual day is of the product that you are primarily trading, what day it actually expires. So that seemed a little bit, shall we say, weak to me, for lack of a better term, that you couldn't figure that out on your own. But apparently FINRA ruled in his favor and said that the broker was incorrect. But then I thought about it, I said, this kind of story is not unheard of. It seems like when you get into the VIX universe and all the products surrounding them, it's just, there's still so much confusion out there, whether it's the way retail options brokers display the options quotes, or whether in this case, how an institutional broker displayed the futures actual expiration date. It's just, if it was any other product, I might just say that's crazy sound. But when it comes to VIX, this kind of almost seems like it's par for the course, that these kind of weird errors. And apparently, the regulator siding in the side of the aggrieved party in this case. Mr. Sebastian, I'm sure you look pretty favorable behind this. You think this guy was worth his $2 million, right?
Oh, are you kidding me?
I knew you had something to say about
this case, and in fact, I remember blasting him at some point. I mean, I get it, okay, that the broker screwed up, but this is FINRA probably doesn't understand the option contract, and I'm sorry, but if you are just that dumb that you can't figure out when an expiration, why are you subjecting yourself to $2 million of losses? This was a guy that clearly had too much on, didn't know what he was doing, and he clearly is not some VIX expert because he didn't know when VIX expiration was. So congrats on pulling money out of the brokers. I mean, good for you, but don't think this makes you any less stupid.
Yeah, that's why I was looking around our studio here while we're recording, and there are about 4 different things I see just within eyesight on my screens, and little handout pop-up calendars all show different expiration dates on them. You could easily look to any of them, even a $2 cardboard calendar, and it'll show you what the expiration date is for these products. So yeah, that's he must have had a good lawyer. That's all I can say. A good lawyer on his behalf to argue well, because interesting stuff. I think maybe the complexity of VIX, or at least the perceived complexity of it, probably played in his favor when arguing to the regulators. Anyway, that's kind of our weird VIX futures story for the week. Stay tuned. Maybe we'll hear more about that in the coming weeks and months. Meanwhile, looking at what was going up out there in VIX land from an options perspective, Jared was right. The options were kind of a bit of a weird beast this week out in VIX land, because the underlying was moving, was rocking and rolling. S&P selling off, Dow selling off, of course, making all the headlines there. And VIX Cash VIX options had a few sparks of life there. Just not even breaking the 600,000 level, but coming close. That seems to be the new ceiling for VIX in this new period, this new frame of reference, where used to have days when it was averaging 700,000, getting it well north of 1 million. Seems recently it's struggled to top that 600,000 mark. In fact, didn't even beat it this week, out to 594. So VIX doing some volume, but nowhere near what we have seen in recent history out there. And looking at what people were actually doing out there, it does seem like still the call love is out in full force. We talked a few weeks ago, of course, about our ever optimistic friends out there in the April 50s. Whatever trade they have on that they are trying to hedge with those April 50s is clearly still on, because the April 50s are still open for some size. At this point, I don't think they're going to take them off for a nickel. So if they can even get that bid out there. So yeah, those things are at a nickel. So those aren't looking too good. I'm assuming the rest of their trade is looking all right. But looking at some of the other big trades we saw going up this week, even yesterday we saw some pretty sizable call love, a little bit closer to home in terms of strike. a little bit more relevant strike than something crazy town in the 850s. But we saw the 820s yesterday lightening up to the tune of a big chunk coming in, 83,000. Someone gobbling up those, just lifting offers for 60 cents. So quite a few going up there. And as we see today, actually, as I'm looking as we're recording the show, another 27,000 going up of the 820s again today. I don't know where what those went up on, but still, maybe it might have been a vertical, might have been the VIX 2023 vertical. But either way, looking at all the top trades going for VIX this week, buying again, someone else piling in for another 27,000 later on of the VIX 20. So it was a lot of upside call buy-in here in 20s and beyond. Someone loving even the June the June 50s getting some love as well. So a lot of just enthusiasm out there for all things VIX to the upside these days. Mr. Woodard, has this been catching your eye as well? Are we back in the period? I mean, it's a little late. It's not February when the crazies usually come out buying the 70s and stuff. Are we getting back into that perhaps more exuberant period where people are just swinging for the fences from a volatility perspective?
You know, we did see one. There was a big trade this week that went up. It was a customer doing. It was in different expiration. There was some big size in April puts. I'm trying to remember the size off the top of my head now. I think it was in the order of like 30,000 contracts or so. And they looked like they were selling April puts to buy later dated call spreads, like I want to say like May or maybe later. And kind of looking for quiet markets now, maybe more volatile moves later, which was an interesting trade. I think this is definitely a situation where volume in VIX has been lower this year. People seem less interested in really aggressive hedges. They just don't see the kind of catalysts, I think, for the short term that would presumably justify those kind of trades.
Yeah, open interest still kind of doing better than it has, obviously, post-expiration and settlement last week when it gets at its nadir, of course, every month. There are about 4.5 million contracts open, about 2-to-1 calls to puts, 3 million calls, about 1.5 million puts. That's nowhere near as call-heavy as VIX tends to be, so we'll see if all this call love drives that north into maybe the 4.5 and 5 range that we've seen in recent history. Speaking of, you were talking short-term, Jared. When you're talking short-term, that's always the domain of the ETPs, in particular our favorite / much maligned VXX. I was looking at some interesting analysis of this done in a few different outlets, I think, including Bloomberg this week. And they were talking about not so much the options, but just the inflows going into these ETPs like VXX, and saying that VXX, probably not surprising, perhaps a bit of a correlation what we're talking about with the upside love in VIX options, has just been getting record inflows over there in VXX land. It absorbed $715 million in 7 consecutive weeks of inflows recently. That's the longest streaks of inflows since one they had back in July of 2012. So coming up on 3 years, 2.5 years or so for that streak. So a lot of love coming in to VXX right now. Of course, people obviously speccing and betting on VXX actually rallying in that case, which of course would correlate with VIX rallying. And at the same time, people who had any sort of short opinion out there in VXX land, so if you're a short seller out there, those people have been pretty much been cutting it out left, right, and center. Short interest has slid about a third since October, when the vol really started coming back into the market pretty hardcore, and falling to its lowest in more than 7 months last week. So the way a lot of retail likes to play volatility, the VXX and other ETPs like that, seeing a lot of love out there. So maybe that correlates with some of the upside call love we're seeing in VIX land. Either way, interesting stuff. I would make another note, too. I was looking at some of the broader coverage of what's going on out there in VXX, and I will say it did kind of please me to see that even in some of the broader publications who were recommending VXX as a portfolio hedge, a lot of them did have a note somewhere in the article saying, hey, because my first reaction, I'm sure probably yours as well, whenever you see this kind of stuff, is, oh God, they're telling retail to buy and hold VXX. We all know how that works out. And yet I did see a lot of people making notes somewhere saying, note, by the way, this is really only for short duration use, and they would try to explain Contango in a way that was palatable to a broad audience. But still, that made me happy that maybe the message is getting out there. Maybe the buy and hold VXX mantra, perhaps, I'm saying perhaps because it's a long shot, but perhaps that's starting to go away. So maybe that's a good thing. Maybe this show is starting to permeate to the masses. What do you think, Mark?
Well, maybe. I still think there's a lot of misunderstanding. I've had to go on television a couple of times and correct anchors that said, "Oh, VXX 52-week low." I said, "You're going to see that a lot, bud."
Are you telling me anchors on CNBC are not immediately conversant in all things volatility? For shame, sir.
Yeah, and no, they are not even remotely, unfortunately. But
VIX Cash is a tradable number. What are you talking about?
Yeah, well, we'll see. It's a tradable number. Well, and it's up 10% today, or it's down 10%, which is absolutely worthless.
That's your favorite. I think you have to let that one go, because that one's never going to end.
Mad, it's so worthless.
Percent of a percent, it's here to stay, sir. I'm sorry.
I refuse to give up on that. Jared, back me up here.
Sorry, what? What am I backing? What am I backing?
One of Mark's biggest pet peeves that when people say VIX moved X percent in a day, because VIX, of course, is a percent, so he gets upset that it's a percent of a percent.
That's totally legit. I mean, you can't quote. I mean, any kind of quoting any yeah, I'm on board with that. I mean, that's ridiculous. It's points. It's like you don't say the price of, the implied vol of S&P puts jumped X percent. Nobody quotes that I see. So just because it's an index doesn't mean it's suddenly,
It should be, yeah. I mean, a point is a point is a point. It's just like batting averages. Have you ever heard somebody say, A-Rod, its batting average is up 10% to $2 to $2.75? No.
Right. I don't think nobody does this with economic indicators either. If you think about, I'm trying to think of anything that's like a bounded economic indicator, and I can't think of one where anyone would ever, quote different, like ISM or PMI indexes that hover around 50. I mean, their diffusion index was supposed to hover around that range. Nobody goes like, oh, U.S. PMI, jumped X percent or fell. I mean, it's just everyone understands that's not the way But I think when it comes to derivatives, people just assume that they don't get it and just kind of punt.
Well, I mean, there are people that know better that still say, percentage stuff, which makes me mad.
But going back to that VXX perception issue, I wonder whether we're not moving in actually kind of the direction of overcompensation here. There's so much coverage these days of the costs of different active investment approaches. I'm talking about the broader financial media here, not just coverage of options markets. There's so much emphasis on the costs of hedge funds or the cost of active management, the cost of options, any kind of effort that someone might make to achieve good returns. And there's this default presumption that everybody on earth should be in a passive buy and hold broad index ETF and should never touch it and should just kind of roll, retirement funds into that product and just sit on it forever. And, obviously everyone's situations are different and you should consult your advisor, et cetera. But, it's just empirically not the case that over very long stretches of time across economic cycles, across countries, across different needs, that a buy and hold passive index ETF is obviously always the way to go. And I wonder whether in the case of some of these other products, there's not some overcompensation in the direction of, I guess from a advising standpoint, no one's ever going to get in trouble for putting people into passive buy and hold ETFs, passive index ETFs. No one's ever going to get sued or harassed. If you try to add some value, you try to provide something that's helpful to someone, and it's a little bit.
Price. You're going to pay the price for that. How dare you try and actually protect your customers and do what's best for them? You should just take the fee and not worry about it. Don't you know that, Jared?
And as these like robo advisors, I mean, even Schwab now making an effort into this area, kind of come on board. You've got just more and more of a push of just kind of gradually corralling every single investor in the country into the simplest, most vanilla, least thoughtful products. And I'm not saying that poses any kind of broad systemic risk or any disastrous situation. But I think if in 10 or 20 years from now, I'd be surprised if there weren't some folks who might be a little bit unhappy with their returns compared to some very, very familiar and easily implementable alternatives.
Yes.
And so anyway, so bringing it back to VXX, I think that there's a place for hedging, as I'm sure you guys do as well, and that there are times when other strategies are worth considering, and I just think it definitely takes some guts and some brains as well to cover these things in a way that's useful. But so yeah, I wonder whether the sort of chorus around VXX, look at how the terrible costs of rolling a constant hedge would be over time. I mean, that's a fair point, but that's also not the way the product's meant to be used, I guess.
No, and if you're smart, one of the guests I want to bring on at some point are Mike and Matt Thompson, who are with a group called Typhon, and they have kind of a systematic approach of being long and short, with the idea of, being short VXX when you want to be short and long VXX when you want to be long, and without beating this drum, the most common misconception about volatility is you want to be long it when it's low and short it when it's high, when really it's almost the exact opposite most of the time. So, one thing to think about, I know you don't do this anymore. I wish you did, but there was a period of time where Jared was involved in kind of this type of hedge, and his approach was always, as the market becomes more volatile, we will hedge off your volatility more and more, and it was an inexpensive and an efficient way to have long exposure to volatility, and there is a dead space of guys that are in that area, and the space lost one of the better ones when Jared went to BCG, unfortunately.
You flatter me, but yeah. Well, no, I think you're right though that those guys have interesting strategy there at Typhon. I mean, they I think they get the best of what we're talking about and really implement those ideas really well. I think that you're right that there's room for that. I think the problem is that it's just a challenge to match the investors for whom that kind of an approach is suitable with the people who can provide it in an effective way, in a scalable way. This was my challenge on the buy side, was offering things that were on the more complex end of the spectrum. There's a lot of folks out there who that's not a good fit for, and or if it is a good fit, it's something that needs to be institutional quality. So I think that's still a challenge in this area, that if you don't fit that style box of value or growth or U.S. large cap or international small cap or any of those very familiar categories, it's tough to get attention from the right folks.
Yeah, they all want to throw you in like long short or XYZ, and what we really need is a new class that says alternative hedged asset or something along those lines. Now there are some of these ETFs that are starting to come out that look interesting. Dow Jones is really trying to push one out. There's a few other groups that are really actually trying to push these ETFs. They all have their strengths and weaknesses, but at least there's some people actually starting to think outside the box, and some people starting to look at the space as really an area that is underserved.
Now, the unfortunate downside to that, literally and figuratively, is of course the farther outside of the box you get, the more difficult it is to attract any capital. I mean, we do a program here on this network called the Advisors Option, where we talk to a lot of advisors and asset managers who do exactly what you were talking about, Jared. They try to add some value beyond just buying and holding a broad-based ETF or the S&P or whatever, and then just riding the market up and market down. They try to hedge, they try to generate income, they try to trade volatility, et cetera, et cetera. And as we've seen with that program, it's a constant refrain from those people that if you use anything derivatives oriented, a lot of doors are going to slam against you automatically. And then of that, the few who can get any sort of track record with, or any sort of traction with investors and people who would actually give them capital to manage, are the ones who A, have a long track record, and B, are doing things that are relatively, you and I would consider straightforward, yet to a lot of these people who are managing the funds, the trustees and the endowments, et cetera, is kind of crazy, which is of course just buying a put, or in some cases doing overlays and getting some income to offset the price of the put, et cetera. And that seems to be really the gist of it for the lion's share of the funds out there. There might be a few small ones doing other little things that have gotten some traction with investors, but for the most part, if you're doing an overlay, you're doing hedging, that's kind of really it. Maybe some income generation as well. If you start getting beyond some of that cool stuff you're talking about there, Mark, with doing long, short, different stuff and different esoteric ratios and exotic hedges and things, I think we all can agree that stuff is needed and it is interesting and is worthwhile to a lot of our listeners out there. But on the other hand, the people who actually have the capital are so reticent to give any money to anything like that.
We need to educate the advisor, and we need to educate the advisor's bosses. So what we really need is really not even just educating the advisor. It's about educating the office managing directors and the area managing directors, and the guys that are in charge of regions, and the guys that actually are a step below the senior level, the absolute corporate senior level, but maybe are at a level where they can influence a grouping of offices to start thinking outside the box. And then it's about educating risk desks so that they understand what they're actually, what is the actual risk associated with these things. So often, the risk management is more about saying no than it is about actually managing risk effectively. Or it's about managing risk of a lawsuit more than it is managing the risk in a portfolio.
Yeah, the risk guys are almost compliance guys now more than anything else.
Which is scary.
And I think I would add to your point there, I would also add to that education equation, the myriad of consultants who are out there who are really the gatekeepers to a lot of these large funds. And one of the things I actually did like about what SIBO was doing with their risk management conference over in recent years, I know they've added a lot of sessions. I didn't go to this year's, and you guys said it wasn't as much focused on that, but in recent years, it had been focused on a lot of sessions designed to essentially how to pitch volatility and volatility-related strategies to the gatekeepers, like the consultants and of the funds and others who are the ones who are, in many cases, standing in the way of these strategies. I thought that was a very interesting approach and certainly something that is needed in the business because there is an enormous universe of people here in Chicago, New York, and others who have a lot of expertise in this space, and there's an enormous universe of people out there who are managing a lot of these broad-based equity funds and endowments and et cetera, and the intermixing of those two is almost non-existent. That's because these gatekeepers have kept such a lock on it, and we need to really break those walls down, which to the betterment of everyone. I think everyone out there really wants, funds that perform much better from a risk-adjusted as well as a total return perspective, and bringing more of that actual legitimate risk management expertise, and not like we were just saying the compliance-oriented version of that, I think is a demonstrably better thing for everyone involved. Before we wrap up here on equity-based volatility, Jared, I know you like to look a little bit farther afield beyond our domestic shores here to see what's cooking internationally. Last week we had some interesting stuff to talk about. We had the Israeli elections, the kind of a bit of a swing and a miss from the Moscow-Russian perspective. What caught your eye from an international vol perspective this week?
A couple things. Number one, Japan's been rallying pretty strongly lately. Implied volatility in Nikkei options is in, I think, the bottom third or so versus the past year. This is unusual because a lot of the data and I think investor sentiment around Japan has been fairly negative lately. So I think this is a little bit of a cross-current situation and possible something worth looking into. Number two, elections in the United Kingdom are coming up in early May, and there's been some pretty notable activity in the British pound versus the U.S. dollar, and where options markets are starting to position for that. That's more currency than an equity, but I think that there may be some interesting opportunities in at the equity options of companies based in the UK as the election gets closer. This was a scenario we saw, ahead of the Scottish independence referendum before, where you had a significant bid up in implied vol ahead of the event, and so that's something I think that folks should keep on their radar. And Europe has been such a surprise hit this year in general. Economic data in the core, especially in Germany, has been really strong, while a lot of the peripheral countries are still looking weak. And so it creates, so it's not just the U.S. versus Europe surprise, it's the fact that there's been such divergence in the core versus periphery in Europe. And obviously that's been a source of tension for some years, but that looks like that tendency is continuing. And so for folks who are able to or willing to trade in companies either through ADRs or ETFs or directly in those markets, I think some of the opportunities in Europe are pretty interesting right now. And then, some of the bigger picture stories are on more of a slow boil across China, and emerging markets are facing consequences of the move in the dollar, and in China's case, the sort of balancing act between avoiding credit expansion to too much credit expansion, while also winding down or rolling off bad debts from the economic expansion phase. And I mean, that's going to be a story that's going to be with us probably for quite a long time. But there's always the potential for things to sort of perk up there if there's some small crisis or small story. And the A-share account story, which is something we've been writing about on and off for several months, has been kind of perking up again as mainland investors get more access to markets, including to options markets. There's definitely things to watch there that I think could create opportunities in the near term.
And let's move a little bit farther afield, as we are wont to do, to the realm of commodities, in particular crude. Crude really catching everyone's eye. We can do a whole show on crude and crude-related volatility, but for now we'll keep it to this segment. And I was looking at some of the trades going up this week. We touched on this a little bit on the option block yesterday, so if you're interested in this, listeners, I encourage you to check out that program as well. But you guys, Jared and Mark, I'm sure remember a few years back when we had that big, they were calling it the Day of Rage in Saudi Arabia, and people in WTI and related products, crude and USO all across the board were just kind of really losing their minds in what they were trading. They were buying 200 strike calls across the board. It was crazy town. They were paying up vol levels that were crazy. What we're seeing this week is reminiscent of that, but nowhere near as extreme, nowhere near as irrational. These are, compared to that, this is far more rational. But what we've been seeing here is some interesting some money starting to pile in on crude, making it back to the par level, particularly by the end of 2018. So a bit of a time horizon there, almost 3 full years you have for that to play out. I don't think that's too wild or exotic of a prediction, but looking at some of the volume that's been going up in the DEAS 2018, this is WTI here, looking at how much of those on the 100, the par level there, that open interest has essentially tripled just from the start of the month to about 2.7 million barrels open on that strike. So clearly, as we mentioned how we're still in that vacillation range in crude, the story every day, it seems like we're rallying one day, getting the legs cut out a little bit the next, volatility kind of hovering around those 50 levels. In fact, we have a great listener question about that in a little while, so I won't hit on the vol too much, but still interesting stuff. I'm not sure if this has caught your eye out there, Jared. Certainly not Day of Rage-esque, but still interesting. Maybe that opens it up to a more interesting question. If you were going to be on one side of this trade, you had to fade this trade one way or the other, would you be on the over on the par level by 3 years, or would you stay maybe somewhere lower in the 75? I know looking at the consensus where the futures are on that level, they're looking at around a 75 or so level they're predicting for that time frame. So clearly south of where these calls are trading. Kind of interesting. Maybe Mark, we'll start with you. What's your take, A, on the paper we're seeing and the vol we're seeing out there in crude land, and then B, where do you fall on, which side of the fence of this trade do you fall on?
Well, I think I think the vol is finally topping out. I think it's range bound. I think one thing we've kind of figured out is that the recovery is going to be more like an L or like a slow sloping L, and I would probably be fading. I'd probably be fading oil and oil vol simultaneously here.
So you're blasting away at these DEAS 100 calls for, I think they were 240 or something, like whatever they were trading.
I would probably look at those in terms of I would use those as part of a ratio spread. A couple of trades I've really liked over the last few weeks have been you could do at one point you could do the 43.40 put 1x2 and receive something like 50 cents or $1 out of it. So I've really liked, they've really set up ratios with the way Skew has been structured and how high vol is that let you set up trades relatively far out of the money and pay pretty decently, and put you in a position where, if I did a 43.40 put 1x2, that would be, and I collect let's say $1 on it. That's what, taking delivery for $36. I mean, that would be relatively inexpensive.
Yeah, I think most people wouldn't turn their nose up at getting some delivery for that level. How about you, Mr. Jared? What's your take on this paper we're seeing going up in the crude land, and what also what's going on from a vol perspective? And then, of course, what's your take on where would you fall on this? I think it was like $2 and change for these DEAS 2018 par calls. You like that? Are you fading that? Where do you fall on that one?
I'm going to defer on that as it's just a little bit specific for what I can,
There's no one listening. It's just me, you, and Mark.
Yeah, what I can easily comment on. Not that I don't want to, but in the bigger picture, I think there's one thing that some folks may not have gotten attuned to yet is the fact that a lot of the hedging demand has been, on the put side of the oil market, has been from customers who are normally opposed to one another. What I mean is that the people like airlines who are typically hedging oil, hedging against upside potential, in the real teeth of this decline in oil prices over the last several months, they've been actual buyers of put options further to the downside. If you think about a typical kind of risk reversal approach, where you're naturally long, or you're naturally short oil, you're going to suffer if you're an airline if the price goes too high. So you can sell puts and buy calls to give you some protection there. But if you sell puts that are too close to the money relative to a given move in the underlying, then as that really starts to sell off, you've got to hedge it in some capacity. And this is, I think, exactly what we saw in the cases of some of these airlines that had to hedge their books by buying back those puts, or even buying further down puts. And they're not normally on that side of the market. And so I think that exacerbated the activity of other participants like exploration production companies and other firms who had to hedge that price decline. And that kind of, I think, is one way to attribute the really extreme level, both of the level of implied vol and also the changes we saw in Skew over the past several months. I don't think that's likely to persist again. Even if oil makes another move lower and for some reason we get a new shock, there's been so much adjustment and response to changes in the market. I'd be very surprised if we saw a similar situation where you had basically the whole industry having to react in a meaningful way to changes in price. I think that folks have gotten a little bit more positioned. So I wouldn't expect, I'd be really surprised to see another leg higher in implied vol. In fact, I think that as Mark mentioned, it looks like we've had a top in implied vol, and that we could easily trend back towards more normal levels. In terms of price on a forward-looking basis, look, the oil's off significantly today. There's still a lot of short-term catalysts, and this isn't like the kinds of short-term catalysts that we've seen before, where someone bombs someone else, and it's the kind of thing that can go back to normal. I think the kinds of scenarios that we're talking about now, especially a deal with Iran, the geopolitics of the Middle East internally, without as much U.S. interference, I should say. I mean, these are all things that could affect supply dynamics in a big way for the medium term. When you combine that with still lingering questions about demand from emerging markets, about moves in the dollar, about monetary policy normalization and how that's going to affect high yield debt, I think there's a lot of good reasons to be sure about a price outlook for oil over the next 6 to 12 months. And until we have more answers on those questions, I don't think it's that easy to make a longer term forecast. Not that it ever is.
Speaking of answering questions, in particular about crude in this case and volatility, I think it's time to do that. So let's dive right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the volatility voicemail. I love it when the announcer man does all those different ways you can contact us for me, saves me having to do that for you. This is, of course, a portion of the show where you guys get to take the reins, send in your volatility-related questions and comments for us here. Going to kick things off. Very, very timely related question to what we were just talking about in crude land. This is the question coming in from Charlie C. He writes, "Hey, Vol viewers. OIV and OVX both hovering around 50, which has the best chance to pop." What he's referring to, of course, listeners, is OIV, which is that SIBO NYMEX volatility index on the actual WTI product itself, hovering, he says, around 50. It's about a 53 right around now, so it is around 50 range. And, of course, OVX, which is the other SIBO VIX index on the USO ETF. And both of those are indeed hovering right around that, actually 50, about 51 for the OVX level. And it's kind of interesting to watch these two. When this question came in, I did look back a little bit on these two indices, because you'd think off the surface of it, the answer would be fairly obvious. Which one is poised to pop? Well, one is essentially the vol, the implied vol, if you will, the VIX methodology of one product, WTI, versus the other one being on USO, which attempts to replicate WTI, but as we all know, is really much more broad-based, has a lot more products in there. I believe there's some gasoline products and other things in that mix. They even say they do OTC, different transactions and things. So there's a lot in that USO blend that makes it not really mimic or crude as it's supposed to. So on the surface, a single product vol versus a more broad-based basket, the single one should have much more of an opportunity for aberrant moves in either direction, up or down. So on the surface, you'd have to say, OIV would clearly be the one more poised. But when you look at these two, they've been tracking each other fairly well over the past 6 months. Both of them kind of hovering in that 30 range until we got into the October or so time frame when things really started lighting up, and a little bit later for the crude perspective into November. Then they both kind of shot off into the levels where we are now. And as we were just saying earlier in the show, both of them have kind of been range bound for the better part of the last few months. Crude vol has certainly found a range. OVX, the USO vol, also having found a similar range and indeed hovering within spitting distance of each other right here at around the 50 level. So if I had to make a guess for Mr. Charlie C, I would wager on OIV, but looking at historical data, at least recent historical data, recent time frame, I'm not as confident in that suggestion as I would have been. Mr. Mark, we'll start with you. What do you have to say for our friend here, Charlie C? He wants to bet on one, OIV or OVX. Which one's more poised to break out?
Well, I mean, it's 6 of one, half dozen the other. The correlations of the two, the volatility correlation of those two is extremely high. I would say, USO is maybe a little less volatile because of the rolling stuff, but for the most part, it's 6 of one, half dozen the other, and I would probably be looking for whichever one has a little more motion, but I don't think either of them is really going to break out. Do you?
Doesn't seem like they've had a lot of opportunities of late, and neither one really has.
I think the breaking out already happened, is my point.
Yeah, that move from 30 to 60 or so.
Yeah, those guys have broken out worse than a teen having just eaten a whole bunch of French fries.
Always goes back to the fast food analogies with you, sir. OVX
I just got a boo from the audience here.
OVX did just have a weird print this week. I think it's just an aberrant print, though. It got kind of spiked from like 47 to 63, which is kind of weird. I think that was more just a weird print than anything else. Other than that, not a heck of a lot. Jared, where do you fall on this OIV versus OVX endless debate/schism?
To paraphrase, I think what Don Schlesinger said about a totally unrelated matter recently. Where's the debate? I would think arbitrage conditions would hold among these two. I mean, I know they're just indexes, first of all, but if, for instance, OIV, that's the CME off CME futures, right?
Yeah, that's on the NYMEX, the WTI product.
Yeah. So if the divergence was significant enough, you could sell options on NYMEX futures. You could buy options on USO. You'd obviously have to sell in the futures market on a weighted basis in the months that would replicate. Effectively, you'd replicate your USO exposure on the other side. And if the divergence was significant enough, you'd have a nice arbitrage trade. My take is that that's really unlikely to happen because somebody would probably do that. And so any discrepancy or any different moves you see in these indexes is, to me, going to be extremely likely to be statistical noise. I mean, I could be wrong, but I don't see any way to get a meaningful divergence among them that's tradable anyway. Or I can't imagine why that would occur anyway. So yeah.
There you go, Charlie C. None of us really over exuberantly confident in any of our picks really for either of these two, because they're kind of moving in lockstep right now. And like Jared said, any kind of significant deviation probably would be more like noise. So they are both hovering around the same levels. It may be tempting, I think, to try to trade one versus the other. but they kind of are separate beasts, despite how similar they may appear on the surface. We got time for one more here. This one comes from Mark. Maybe Mark, you're writing into the show. But actually, this refers to a listener question. I know you missed a listener mail last week, Mark. I'll just fill you in. We had a listener write in. I'll see if I can find that person's name and give them credit. It was a great question. It was kind of a thought piece on, what really is the kind of lowest, what's the lowest VIX can go? What is the kind of structural level of vol that we could get in the marketplace? And he kind of had a corollary to that. He said, what would have to happen to get VIX just really low, crazy low, like well south of 5 into like 2 or 3 range kind of thing. So Jared and I were kind of joking on the show. They would kind of have to be kind of the world peace at end of all conflict, pure market harmony, just complete staid, most relaxed, benign, nothing on the horizon picture you could possibly foresee to have that last for any foreseeable period of time. This other person writes in with a kind of a follow-up to that. He writes, this is Mark, he writes, I like the discussion about the structural volatility of the market from the last episode. Allow me to pose a related thought question to you. Mark Longo, that would be me, stated on the show that it would take, quote, world peace and perfect harmony to the markets to get the VIX below 5 for any substantial period of time. I don't know if I said those exact words, but something along those lines. But what if the S&P were to double or even triple in value? According to the skew curve, wouldn't that bring us down into a VIX in the single digits, perhaps even below 5? Probably more feasible than world peace. A good show. I have to side against Jared in the Fed wager. The odds of a raise this year don't look very good. If I throw my hat into the ring, can I get in on the inevitable steak party that Jared will be throwing in Chicago? I like my T-bone medium rare, please. Well, there you go. He's a little late to the game on that one. He wants in on your steak party, Jared. What do you think to that?
I'm really glad that I've got this massive OTC book on effectively, Fed funds futures. No, I actually don't. I'm kidding for the purposes of anyone listening. I mean, people don't realize you can actually trade this stuff. You don't just have to try to get free steak out of me. There are euro dollar futures and options out there, or 2-year if you don't want to. There's lots of good short-term interest rate products. But I'm certainly happy as well to receive steak eventually in New York, probably around September of this year. So yeah, I'll take all comers. Fantastic.
I think he's saying the steak will be that much more tasty if he gets it from you, Jared. Is what he's saying.
I don't know.
You think, Mark, you let this guy horn in on your action here?
What's going to happen is right around the time we're clear that one or the other is going to happen, we're going to get all these emails of people trying to pile on. So
you're right.
Johnny come latelys to the bet. That's my opinion.
It's going to be an exploding steak party pretty soon.
Exactly. It's going to have some sort of. It'll be like trying to calculate realized volatility the day before expiration. So. That's how nerdy the show is. People laugh at that joke. So I'll be honest. So here, Mark, here's the way I think that the VIX could get below 5%. Imagine that the Federal Reserve engaged in a form of quantitative easing that caused it to buy equities along with bonds, as such that they basically created beyond the Fed put, they became the biggest buyer of U.S. securities. That would be something that I could imagine driving vol into. Yeah, that could be something that I could imagine driving vol down to 5%. Yeah, and one of the guys here just mentioned, hey, isn't that kind of what they're doing in Japan? I don't know where Nikkei vol is, but if the Federal Reserve really executed that, and along with all the corporate buybacks, we could then see volatility get low enough. One of the strong, there's a lot of people that believe that part of the reason why volatility has fallen and why the market has kind of this embedded floor is just the ginormous number of corporate buybacks. Now, in terms of the question regarding the skew curve, one thing to remember is that what the skew curve really represents is kind of how things are priced as a percentage of how far they are out of the money. And yes, as an underlying rallies, it will increase. But think about this, okay? Here we are with the VIX around 15. We've had the VIX at 15 with the S&P below 1,000, below 1,500, below 2,000. So volatility has in a very short period of time, you would have that sense along the skew curve. But because it normalizes, while a large increase in assets would cause, in the price of assets would cause an overall decrease in volatility, it wouldn't be to the point where you would get 5%. So, if the S&P makes a move from where we are to 3,000, just because the $3,000 call is 5% in terms of IV, that doesn't mean it's going to that doesn't mean that 3,000 call is going to be 5% again.
Yeah, people always look at the skew chart like it's, gospel. It's really just kind of a suggestion for what things should be, all things considered, if we got there. But of course, the question is how we get there. And in your example here, Mark, I'd imagine we have to move pretty rapidly to have the S&P double or triple in any sort of reasonable time frame. And that, of course, is going to be a pretty rapid movement. We all know rapid movements in any direction tend to generate some vol, and a lot of other things go into that conversation. So it may seem tempting to look at the skew chart and say, yeah, that's what it says. But how we get there is a big part of that process. I have a feeling that if we got that dramatically that fast to the north, it'd be a little bit higher than 5. But hey, you never know. Things are crazy. Jared, what do you have to say here for our friend? In addition to not letting him horn in on your stake, what about his skew hypothesis here?
Yeah, I think Mark's right. I think that the skew curve is going to move along with the level of the underlying. Just as if you look back at what the curve was, 200 S&P points ago, options that are currently at the money were priced lower in terms of in terms of the level of implied vol. So the whole curve shifts over time as the index moves, and so that's why, unless you had a 200 point 10% jump or something like that overnight, you're not going to see the level of VIX generally trend lower for skew reasons over any meaningful period of time. That QE hypothesis of Mark's just now, that's pretty interesting. Yeah, I think your office mate might be right, though. I mean, I wonder if that Japan example isn't instructive. You could definitely argue that the capacity to buy ETFs as part of their current program, the fact that they've been pushing the government pension fund to increase its allocation to equities. I mean, these are all arguably causes of the rally in Japanese equities and the decline in implied vol. Although the Nikkei implied vol has not pushed to record lows. Right now it's in, I think, like the 30th percentile or so versus the past year. And so and part of that may just be that there's been contrary fiscal policy as they change consumption taxes and do other things to try to deal with their debt situation. So yeah, it's interesting hypothetical though. It'd have to be really aggressive, I guess. And I think arguably a kind of a semi-permanent or at least very long-term commitment to get people to price risk that low. And I still even then I have a hard time.
I know.
Would you ever sell an at-the-money S&P, say 3-month put for 5%? I don't think I would.
I mean, you would literally need to have the Federal Reserve say, we will buy assets at all prices as high as they go till XYZ, and like you would need a more aggressive buying program of equities than what we saw with QE, with the most recent round of QE. It would have to be that aggressive.
It sounds like, Mark, it sounds like the argument you're actually making is that the surest way, the easiest way, and the most direct way to avoid unwelcome volatility in the market, to ensure the smooth functioning of markets, is for them to be centralized.
Well, no, I didn't say that. All right. I didn't say that that's what the Federal Reserve should do. What I'm saying is that what would happen if the Federal Reserve did that. There should be risk associated with actually owning the company. Otherwise, the idea behind equities and why they theoretically should have a higher return, right, is because there's risk. And so if the Federal Reserve were to jack up risk premiums so bad that there was no risk in equities, I mean, the long-term effects as they tried to unwind would be catastrophic.
Anytime, any day I get to accuse you of being a socialist and make you defend equity markets, it's a pretty good day.
Yeah, you got me pretty good there.
That is a good note to end on. Unfortunately, that's all the time we have for this episode. Great. I love our listeners. They come up with such great thought questions. And of course, all these other hypotheticals we put out there, the Fed doing all these things, still all it would take is, one little invasion from Mr. Putin or, another Greek default, and bam, we're way back over 5 again. So a lot of things have to hold fast in that hypothetical for us to maintain that south of 5 level. But you're right, Jared. At the end of the day, I wonder if structurally we are, above that 5 level from an overall VIX. Still great questions. We love to have you guys sending in these thought pieces and all your other questions. You know how to do it. The announcer already said it. But that's all the time we have for this show. So we're going to wrap up really quickly here with a kind of combo crystal ball as well as what's coming down the pike segment. Maybe, Mark, we'll start with you. Give us your quick prognostication for the week to come from a vol perspective, as well as what you guys are cooking up over there at the pit that may interest our listeners.
Got the next one of our free webinar series coming up on April 8th. Go to optionpit.com/weekly trades, and we cover how to trade. We're going to do a free webinar covering how to trade weekly options and kind of an introduction and, discuss some of the decay. And in terms of crystal ball, I think that we're going to see Janet Yellen make herself into a 1/4 moisturizing cream. She's going to be so dovish. We're going to hear Janet Yellen. Her monetary policy is going to sound like this.
Jeez. Are we going to invite Miss Yellen to our steak party?
Miss Yellen, I'll tell you, if I get a free steak out of Jared would buy Miss Yellen a steak.
I would think so, yes.
I would buy Chair Yellen all manner of. It would violate rules, I'm sure.
I was going to say, be careful where you go with that. Maybe let's move on to your prediction, sir.
Predictions. I predict that I have no idea what will happen next week because who does? And I predict also that I'll just plug. I don't plug stuff that often directly, but I've been doing spots for Bloomberg on their option segment every week, and so maybe on Wednesday next week, about 5 or 10 minutes before noon, if people want to see what I look like in person. And
trust me, you don't.
Hey.
Just kidding.
My other thing I'll mention is this is tangentially options related. The Fed's been making this distinction for years between inflation expectations and inflation compensation. It's a little bit nerdy, but really important, especially given that inflation is one of the last dominoes to fall, and people are focusing more and more on this issue, and I think it's going to be really crucial in the months ahead. People, especially in the press, but even investors, have really not got their minds wrapped around this distinction, even though the Fed's been trying to make it for quite some time. So I've been writing about that in a number of different places, at Global Capital, in stuff for our clients. And I think it's a really important distinction. There's an analogy here, I think, with the difference between equity markets and VIX, between the forecast for an asset and the cost of insurance on that asset. And so I think folks might want to seek out that writing. You can get in touch if you want to learn more. But I think it's a really important difference that deserves a lot of attention. And it's complex enough that I understand why the Fed hasn't gotten much traction. But I've been writing about that lately, and I probably will in the future. So look out for that.
Good stuff, sir. Make sure to tune in and check out Jarrett in his finest tweed jacket with the elbow patches. Yes, he was a philosophy major, listeners, so he brings that to all of his appearances. Well said, sir. And, of course, on behalf of Jared and Mr. Mark and, indeed, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, for sending in such great, very, very out-of-the-box questions. We love to hear them. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. Or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/The Options Insider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.